Silver just touched $91, and then everything changed. Not next week, not in some future announcement. Right after that spike, the CME stepped in and changed the game. Higher margins, stricter requirements, more friction to hold the exact same position you had 5 minutes earlier. And that single move instantly flipped the mood from this is unstoppable to wait. Who just took control of the steering wheel? So today, we're breaking down exactly what happened, why that $91 print matters so much, what those rule changes really do to price action, and what the next phase could look like for silver, gold, and the mining sector. Silver ran hard into $91, and it wasn't a gentle climb. It was the kind of aggressive push that makes traders sit up straight, makes headlines scramble to catch up, and makes risk managers across Wall Street start sweating. Then the exchange changed the playing field. And even if you've never traded a futures contract in your life, you absolutely need to understand what that means because it affects the whole market. It affects spot pricing, it affects sentiment, and it affects the way big money behaves. Here's the simple version. When margins rise, the trade gets heavier. You need more cash to hold the same exposure you had yesterday. That forces some people to reduce their positions immediately. It scares others from entering new ones, not because the fundamental story changed, but because the cost of participation just went up overnight. That's exactly why these moments create the same pattern over and over again. You get a surge, then a rule change, then a wobble, then panic, and finally a decision point. The only question is whether that decision point becomes a real reversal or just a mid-move fake-out that actually launches the next leg higher. If you've watched markets for long enough, you already know the answer is rarely simple or clean, but the clue is always in the reaction, not the news itself, not the opinions flying around social media. The reaction, because strong markets absorb pressure and keep walking forward like nothing happened. Weak markets crumble the first time the wind changes direction. So let's talk about what people are missing right now. Most people are staring at the dollar price and asking themselves, am I too late? And yes, buying at $20 would have been nicer. Buying at $30 would have been nicer. Nobody's going to argue with that basic math. But being late isn't just about absolute price. Being late is about positioning and narrative. Late is when everyone believes the same thing at the same time, when the mainstream media applauds the move, when your barber is giving you price targets, and when you feel completely safe buying because it already went up so much. That's late. That's not where we are right now. Right now, the tone is still suspicious. The coverage is still weird and uncomfortable. The financial networks still treat gold and silver like they're guilty until proven innocent. Stocks can grind higher by tiny increments day after day and get praised like heroes saving the economy. But metals move 5%, and suddenly it's excessive, dangerous, overdone, and unsustainable. The translation is simple. Stay out. Don't participate. You'll get hurt. And honestly, I actually prefer it that way. The truly explosive phase comes when the crowd finally sprints in all at once. If they're still actively trying to keep people on the sidelines, we're not at the end of the move. We're in the messy middle, where the biggest gains are usually born. Think back to every major commodity bull run in history. Oil in the 2000s, copper during the China infrastructure boom, even tech stocks in the late 1990s. The biggest gains didn't come when everyone already believed. They came in that uncomfortable middle phase where skeptics still outnumbered believers. That's the phase where fortunes get built, not at the top, when your neighbor is asking how to open a trading account. Now let's address silver specifically, because silver doesn't behave like gold at all. Gold is a tank. It's steady. It's powerful. But it's not built for the same kind of percentage violence. Silver is. Silver is the metal that can sleep for months, barely moving, then suddenly move like it's absolutely possessed for weeks on end. And that's because silver occupies this unique position. It's both monetary and industrial. It sits at the crossroads of fear and necessity. When money wants protection and industry desperately needs supply, silver can gap in ways that shock even experienced traders. That dual identity is exactly why silver's breakouts feel so unfair. They don't politely rise on a smooth curve, they explode. Then they violently try to throw you off the ride. Which brings us right back to the CME change. A lot of people heard rule change and immediately translated it in their minds into, they stopped it, they killed the rally, it's over. But that's not how this actually works. A rule change doesn't cancel a trend. It adds friction. It can force a pullback. It can create a brutal shakeout. It can slow the move down and flush out weak hands. But it doesn't magically erase the fundamental reasons why the move started in the first place. Think about it like this. If absolutely nothing was happening, if the market was dead and boring, nobody would touch the rules. They change rules when real pressure shows up. They change rules when volatility threatens the stability of the system. They change rules when exposure becomes uncomfortable for the people managing risk at the exchange level. So in a strange way, the fact that they reacted so quickly is actually a form of confirmation. The move mattered enough to trigger an immediate response from the people who run the infrastructure. Let me give you a historical parallel. Back in 1980, when silver went parabolic toward $50, the rules got changed multiple times. The Hunt brothers were trying to corner the market, and the exchanges changed margin requirements. They changed position limits. They changed delivery rules. And yes, silver eventually crashed from those highs. But here's what people forget. The crash came after silver had already run from under $5 to $50. That's a 10x move. Even if you bought halfway up the mountain and rode it back down, you still had opportunities to profit if you understood what was happening. The rule changes back then were more extreme because the situation was more extreme. One group was literally trying to own the entire available supply. Today's situation is different. Today, you have widespread physical demand from multiple sources. Industrial users who can't function without silver, solar panel manufacturers, electronics companies, medical equipment makers. You have investment demand from people who don't trust the currency system. And you have shortage signals appearing in multiple markets simultaneously. That's a very different setup than one group cornering the market. So when rules change today, it's not necessarily the death of the move. It's often just the system trying to manage velocity, trying to slow things down so the infrastructure doesn't break. Now let's talk about the shakeout, because this is where most people lose money and give up right before the major move happens. When markets enter a breakout phase, they rarely go straight up in a clean line. They do a thing I call the jiggle. It's a violent mid-move reversal that looks and feels exactly like the top. It convinces late buyers they were completely wrong. It convinces early buyers to take their profit and run. It convinces spectators sitting on the sidelines that the story is finished and they were smart to stay out. Then, when all the emotional selling is finally done, when everyone who was going to panic has panicked, the trend quietly resumes and rips to new highs. That's the trap. It's been the same trap for decades across every asset class. And the CME margin change is the perfect ingredient to create exactly that kind of trap. It gives the market a reason to wobble. It gives commentators a story to scream about. It gives fear a headline to rally around. And fear is the absolute best tool to separate you from a winning position before it really pays off. I've seen this pattern play out in gold, in oil, and agricultural commodities, even in individual stocks that break out of multi-year bases. The pattern is always similar. Break higher. Scary headline, violent pullback, despair, then resumption. The people who understand this make money. The people who react emotionally to each headline get chopped up. So what should you watch instead of the headlines and the panic? Watch whether dips get bought aggressively. Watch whether silver holds above key breakout zones, even if it dips temporarily. Watch whether gold stays firm while stocks start to get tired and lose momentum. Watch whether mining stocks start outperforming the broad market on a relative basis. Those relationships tell you where the real flow of capital is going. Because the real story here isn't only about silver hitting $91. It's about rotation. We're watching capital slowly, quietly, shift away from overcrowded trades and toward hard assets. Not everyone is doing it yet. The public isn't doing it. But the early institutional flow is visible if you stop staring at the surface price and start watching the behavior underneath. The S&P 500 can print new all-time highs while feeling completely exhausted. It can crawl forward, making marginal new highs and still be in distribution, which means smart money is quietly selling into the strength. Meanwhile, gold can surge 40% in a year and still be ignored by mainstream portfolio managers. That combination, strength in metals with apathy or hostility in the financial media, is often the early stage of a regime change. And when regimes change in markets, ratios matter enormously. One of the cleanest ways to understand the silver move is to think about silver relative to gold. Over history, there have been moments where silver reached a much larger percentage of gold's price than it does during quiet, sleepy periods. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has historically averaged somewhere around 50.1 over very long time periods. But during quiet times, that ratio can stretch to 80.1 or even 100.1. That means silver gets extremely cheap relative to gold. Then, during periods of monetary stress or industrial demand surges, that ratio can contract dramatically. It can go to 30.1 or even lower. When that happens, silver doesn't just match gold's percentage gains, it massively outperforms. So even after a big run, silver can still be historically cheap relative to gold if that relationship hasn't normalized yet. And that's why the upside potential can be so dramatic. Not because silver needs some fairy tale to play out, but because the mathematical relationship between the two metals can stretch and contract based on supply, demand, and monetary conditions. Right now, even after silver's recent move, the ratio is still elevated compared to historical crisis periods. That suggests there's still room for silver to catch up. Now bring mining stocks into the picture. Miners are the leverage play that most people either love at the absolute top or hate at the absolute bottom. And the reason they get burned so badly is because they trade mining stocks like emotions, instead of treating them as a structure with specific characteristics. Here's the structure you need to understand. The mining sector is absolutely tiny compared to the ocean of money sitting in broad equity index funds. The entire global mining sector, all the gold miners and silver miners combined, is smaller than many individual tech companies. When even a small percentage of capital rotates out of bloated index exposure and into the mining sector, miners can move like rockets. That's not magic or hype. That's pure math based on market capitalization and liquidity. The other structural point is valuation. For years, mining stocks have been priced like a dead industry going nowhere. Some of that was deserved. They had problems with cost inflation, shareholder dilution, and management teams making bad decisions. But long periods of neglect create enormous opportunity when the fundamental tide finally turns. If you look at the price-to-earnings ratios, the price-to-cash flow ratios, the dividend yields on quality mining companies right now, many of them are priced like they're going out of business. But their underlying assets, the gold and silver in the ground, are becoming more valuable every single day. That creates a leverage situation. When the metals move higher, the mining companies don't just move higher by the same percentage. They often move by multiples of the metals move because their profit margins expand dramatically. Let me give you a simple example. Imagine a mining company that produces silver at an all-in cost of $20 per ounce. When silver is trading at $25, they make $5 per ounce in profit. Now, if silver goes to $50, they're not making twice as much profit. They're making $30 per ounce in profit. And that's 6 times more profit, not 2 times. That leverage is why mining stocks can explode during metal bull markets. But it also works in reverse, which is why they get destroyed during bear markets. So if you're still haunted by memories of mining stocks collapsing during past periods of equity chaos, I understand. But you need to understand this crucial difference. The setup depends entirely on relative strength. If miners are breaking higher relative to the broad market, if they're making new highs while the S&P is struggling, the condition is fundamentally different from a period where everything is collapsing together. It suggests money is actively choosing the mining sector, not just abandoning everything in a panic, and that's the kind of signal that can precede a powerful multi-month or even multi-year run, especially when the metals themselves are showing strength. Now let's step back and ask the most important foundational question. Why did silver hit $91 in the first place? Because markets don't move like that for no reason. Even if you completely ignore every single data point, every supply and demand chart, you cannot ignore the psychology driving the move. People are tired of fake stability. People are watching currency creation on a scale that would have been unthinkable 20 years ago. People are watching government debt numbers that no longer make sense in any historical context. People are watching political risk increase across multiple major economies simultaneously. People are watching official inflation statistics that don't match their real lived experience at the grocery store, at the gas pump, in their rent payments. And in that environment, hard assets stop being a hobby for gold bugs and start being a lifeboat for people who want to preserve their purchasing power. That's why the narrative around metals is always so strange and uncomfortable in mainstream financial media. Metals don't just threaten individual portfolios or trading positions, they threaten confidence in the entire monetary system. A rising metal price is a scoreboard that clearly says the currency is losing purchasing power. It's a vote of no confidence in central bank policy. It's a signal that people don't trust the promises being made by governments and financial institutions. So the incentives around the conversation are not neutral. The people who benefit from the current system have every reason to talk down metals, to make them seem risky or foolish or outdated, which is exactly why you will keep hearing the same phrases repeated over and over. Overbought. Excessive. Too late. Dangerous bubble territory. The goal is always the same. Make you doubt the move before it fully matures. Make you feel stupid for considering it. Make you wait for a better entry that never comes. Now here's the cliffhanger question. What if $91 wasn't the peak? What if $91 was just the test? Markets often spike to prove a certain level is actually possible, then slam back down hard to scare everyone away, then rebuild from a higher base level and launch again with even more power. That pattern is older than the internet, older than electronic trading, older than modern exchanges. It's a pattern that shows up in market data going back over 100 years. And the CME rule change could be providing the perfect excuse for that slam lower, that violent shakeout that scares away weak hands before the next major leg. So if you're sitting there waiting for perfect confirmation before you act, you need to understand what confirmation usually looks like in real time. It doesn't look like a clean, safe, obvious entry with no fear. It looks like you buying at a worse price when the public finally believes, and the move is already well underway. That's why I keep saying this. Missing the absolute bottom doesn't mean missing the move. The bottom is a single moment. The move is a process that can last months or years. The bigger money is made in the sustained trend, not in catching the first candle perfectly. Now I want to make this practical with a simple roadmap you can actually use. First, expect volatility. Expect it. Prepare for it. Accept it. If you can't handle volatility, if you panic when your position drops 10% in a week, you shouldn't touch silver or silver-related investments, even indirectly. This asset class is not for people who need smooth, steady gains. Second, separate your time frames clearly in your mind. Short-term noise is specifically designed to shake you out. Long-term structure is what actually builds wealth. Don't confuse the two. If your time frame is months or years, stop watching every single day's price action like it matters. Third, watch the behavior after this rule change carefully. If the market shrugs it off and keeps pushing higher, that's strength. If silver dips and then gets bought aggressively with strong volume, that's strength. If it collapses and can't recover for weeks, that's information too. It tells you the move might have been premature. Fourth, watch the mining stocks relative to the S&P 500. If miners continue to gain relative ground, making higher highs and higher lows while the broad market struggles, the rotation story is alive and well. That's one of the most reliable signals that the next leg is coming. Now, quick creative interruption, because I know many of you want real-life motivation, not just abstract charts and theory. If you want to hear silver-related success stories, real people who built real wealth, there's a link in the description to another channel where people share exactly how they built wealth using metal strategies, discipline, and smart risk management over time. Subscribe there too and watch a few of those stories. Some of them are absolutely wild. Some of them are simple and boring, but incredibly effective. All right, back in. Let's also talk about why the CME move feels so personal to people who are paying attention, because it highlights an uncomfortable truth about how markets actually work. Markets are not a pure democracy where everyone has equal power and equal access. They're a system with gates and gatekeepers. And when those gates tighten, smaller players feel it first and feel it hardest. The big institutions with massive capital bases don't care as much about a 15% margin increase. They have the cash sitting there. But the individual trader using maximum leverage to get exposure suddenly gets forced out. That creates anger, distrust, and ironically, even more interest in owning the actual physical thing outside the gate, outside the system that can change the rules on you overnight. That's why these rule changes can actually backfire from a narrative perspective. The more people believe the game is being actively managed to benefit certain players, the more they want exposure to assets they can physically hold in their hands, not just paper claims that can be altered or frozen or cash settled against their will. Now, let me ask you two direct questions, and I genuinely want real answers in the comments section. First, do you believe the CME rule changes are simply responsible risk control, just standard procedure to manage volatility? Or do you think they're actually a tactical way to protect certain institutional positions from a runaway market that could cause major losses for banks and funds that are short? And second, if silver does a violent mid-move jiggle from here, if it drops 10% or 15% over the next few weeks, will you treat that as a buying opportunity, or will you assume the entire run is finished and walk away? Drop your honest view below. The best comments and the most thoughtful responses directly influence what topics I cover next and how deep I go into specific areas. And while we're here, if you're one of the successful people watching this right now, maybe you've built a solid portfolio over the years. Maybe you've stacked physical metal consistently through multiple cycles. Maybe you've turned discipline and patience into real financial results. Share a quick success story in the comments. It genuinely helps other viewers realize this isn't just theory or speculation. Real people are winning quietly in this space while the crowd chases meme stocks and lottery tickets. Now I want to close the loop on the too late fear one more time, because it's the number one thing that stops people from acting. People think late means price is higher than it was before. But price is just one dimension of the equation. What actually matters is whether the move is early in the adoption curve. If the general public is still skeptical, if the mainstream media is still hostile, if the system is still tightening rules to slow things down, and if the asset is still fighting for basic respect and legitimacy, that is not the late stage. That's the stage where the next major leg often forms. History shows this pattern clearly. In the early 2000s, gold was trading under $300. People who bought at $300 thought they were late because gold had been $250 just a short time before. Then gold went to $400, and people said, too late? Then $500, too late? Then $700, definitely too late. Then gold went to $1,800 in 2011. The people who bought at $400 or $500 or even $700 and held through this volatility made enormous returns. The people who kept waiting for the perfect entry, who kept saying too late at every level, made nothing. And here's the final retention punch to lock this in. The most dangerous moment in any breakout is right after a major headline event, because that's when your brain desperately wants certainty. Your brain wants a guarantee that everything will be fine, but markets don't pay you for certainty. Markets pay you for managing uncertainty better than the crowd manages it. So don't let one rule change. One scary headline, one temporary dip hypnotize you into thinking the entire multi-year story is over. Let the market actually prove it with sustained weakness, not just a few bad days. If silver stabilizes above key levels and keeps pushing higher over the coming weeks, the rule change becomes just a footnote in the history of this move. If silver shakes out violently and then rips to new highs in a few months, the rule change becomes the exact reason the crowd got left behind while smart money accumulated at better prices. Either way, you now understand the mechanism. You understand why rule changes happen, what they mean and what they don't mean. And that understanding is power. That was the moment the system reacted. The next critical moment is how the market responds to that reaction. And that's where the real move, the sustained trend that builds wealth, usually reveals itself. Here's the behind-the-scenes detail that most people never think about. When the exchange raises margin requirements, they're essentially saying, this market is moving too fast. We need to slow it down before something breaks. Your broker immediately enforces the higher requirement. And if you don't have enough cash sitting in your account, you don't get a long philosophical debate about it. You get a margin call, or you get automatically trimmed out of your position. That's why price can dip sharply right after these announcements. It's not that everyone's suddenly changed their mind about silver's fundamental value. It's forced mechanical selling. People who were using leverage don't have a choice. So never confuse a sudden technical drop with a sudden change in the bigger fundamental story. Sometimes absolutely nothing changed about the underlying supply and demand situation. The only thing that changed is leverage got squeezed out of the system. Now here's what matters going forward. If silver can absorb that squeeze, if it can hold above major support levels even after forced selling, that actually means the buyers underneath aren't just gamblers using maximum leverage. They're committed buyers with real capital who aren't relying on borrowed money to stay in the position. And when weak hands get forced out of the market, when the leverage gets flushed, the next push higher can actually be much cleaner and more sustainable because the market isn't packed with people who will panic at the first ugly red candle. There's another important twist to consider. Rule changes like this can actually push people away from paper exposure in the futures market and toward physical ownership or longer-term positioning in other vehicles, because nobody likes playing a game where the cost of entry changes overnight without warning. That shift doesn't always show up instantly in the price, but when it does show up over time, it tightens the real-world physical market. It reduces available supply, it increases premiums on physical metal, and that creates its own feedback loop that eventually pushes prices higher. So watch the sentiment carefully. Watch how people talk, and watch what they fear. Watch what they're quietly buying while publicly claiming they're still waiting for a better entry. That's where the next moves leave clues before the price chart does. Because the next big surprise might not be a gradual new high. It might be a sudden gap. It might be a weekend headline about a supply disruption. It might be a major industrial buyer publicly complaining they can't source the silver they need for production. It might be a sudden shortage narrative that appears after everyone relaxed and assumed the excitement was over. And if that happens, if some catalyst appears that nobody was pricing in, the people who hesitated because they wanted one more perfect dip, one more confirmation, one more sign, will be the ones desperately chasing price higher. So I'll say it one final time. The story isn't whether you bought the absolute bottom. The story is whether you can recognize what phase you're actually in and whether you can stay calm when the chart tries to bully you with scary candles. Stay sharp, stay patient. Watch the reaction to this rule change, because the reaction is where the truth hides. The headlines will lie to you, the commentators will try to scare you, but the price action, the volume, the behavior of the market itself, that tells the real story if you know how to read it.